Well, thank you very much, everyone. And thank you also for the invitation to moderate what I'm sure will be a fascinating topic. As financial editor of the FT, I spend a pretty fair amount of my time thinking about the topics of finance and growth in various forms. So I'm delighted that we have a panel of such distinguished guests to inform that debate and hopefully give me some great ideas for writing future articles. At a very macro level, this is obviously a broad topic, finance and growth. I wondered if we could start with the big picture, and maybe with Douglas. Here in the UK, we've had a very upbeat week in some ways. We had George Osborne, the UK Chancellor of the Exchequer, deliver a pretty barnstorming address when he presented the budget the other day, talking about Britain being walking tall again. You could be forgiven for thinking that we were in a really resurgent economy. However true that might be in parts of the UK, I suspect it's not true across Europe in the views of my panelists, but maybe I'm wrong. Douglas, maybe you could start off by giving me your big picture thoughts.
I actually get a bit more confident than I have been for some time. I think that one of the very positive things about the new Commission is the prioritisation of growth and jobs. And it's kind of crazy in a way to say, well, what were you doing before? But in a sense, there was a repair job to be done on the back of the financial crisis. And I think that if the prism through which every piece of regulation and legislation and initiative is viewed is through what is the impact on creation of wealth and creation of economic activity, then it's a much more positive view than one that says we need to continue to put constraints on the system. So I think, the point you made at the very beginning, I mean, we all know about the policy tools that are available for fiscal policy and monetary policy and inflation targeting and so on. There's no policy tool for confidence. And if there's no confidence, then people aren't going to invest, people aren't going to spend money and so on. And I think it's the job of government, to the extent that they have the backup of statistics to support them, to try and engender that confidence, to get people taking the benefit of the very cheap money that's available today to begin to spend, and that becomes self-promoting. So I think there's an awful lot, I'm sure we'll get into it later on, but there's an awful lot of good things, I think, happening in Europe to try and get confidence and to try and build a framework which will lead to economic activity.
Nikhil, I suspect you don't share that confidence.
No, I don't disagree. I just think confidence is absolutely right. But, people have talked, and I think the person who announced us mentioned the European ECB's QE strategy, and that's great, but that buys you time. That doesn't solve the problems. And I think Spain started the ball rolling with structural reform. Italy's now got it going. The French are trying. Really what we need is to create jobs in Europe. And I think if you start to see investment and job creation, then you're going to really get that confidence back, the way I think Douglas is defining it right now.
Do you think, though, that people are overestimating the speed with which we can bounce back from what have been a pretty torrid 6 years?
I think you can bounce back pretty quickly in the next 18, 24 months in terms of you've got a weaker currency. I'm talking about the Eurozone here. You've got a weaker currency, you've got oil collapsing, it's falling again. It's going to fall another $10, $15 probably. You've got the export push that comes. You've got less of a fiscal drag with the European Union saying, okay, you don't have to run, you don't have to cut the way you've cut in the last few years. So all this will help. So I think the next year or two will show very good GDP numbers, relatively speaking. So when you're expecting 0 and you get 1, that's fantastic. Okay, so you're going to see a good bounce back in the next 2 years. Beyond that, it all depends on the reforms you do.
Vittorio, as an Italian who spends a lot of time travelling around Europe in your capacity at JP Morgan, how do you see that kind of outlook?
I am as well very optimistic. We are optimistic. I think the cyclical factor that were mentioned are very powerful. Each one of them in the past was very significant. Just cheap money, cheap oil, cheap euro. they're a big booster. So we see it as a great opportunity and reality coming. Of course, the issue of confidence is a major issue, but I believe that it's easier to build up confidence or regain confidence during good time, even if they are cyclical, but during really bad time. And but we heard from the previous panel, really the headwinds are within Europe, issue of governance, because part of the lack of confidence is that really people don't really understand, how Europe is governed, how the decision making works, what is really the objective that this decision making is aiming to. And of course there are instability factors still within Europe, still unresolved Greek issue, which now somehow the market for now has put a ring fence and put somehow in a refrigerator, waiting for what's next. But still, I think could be full of bad surprises if not handled carefully. And then the outside risk, still, geopolitical risk are the potential headwinds that could spoil a little bit the good times coming.
One other macro factor we haven't touched on, and I was chatting with Nikhil before the panel about this oil. Nikhil, what do you see as no one knows really when oil is going to end up, but what should the world be wary of there?
Well, there's too much supply, and supply is not being cut back. The US is producing more oil today than it has in the last 40 years. And demand, if you look at demand in oil in the last 10 years, most of it came from emerging markets. And everyone here knows what's happening to Chinese growth. It's slowing down. So I see too much supply and not enough demand. Okay, there's only one way oil is going, and that's down. Now, it's very dangerous to call inflection points, and I think we like to do that. We like to think, it's going to turn now, whatever's going. I wouldn't call any inflection point on oil. I'd simply assume it's going to keep going down. So that's good, actually, for countries like China and India. They can cut interest rates more. But with countries you can't cut interest rates, and our commodity exporters particularly, that's actually quite bad. So my view on oil is net positive for countries that are oil importers and have the ability to cut rates. Good for Europe overall, because Europe is an oil importer, and no ability to cut rates anymore, but that's actually very good, in terms of input cost.
Douglas, would you agree with that?
I think there's some really quite big structural changes taking place because of the change in the oil price. And it's actually encouraging to see countries like India and Indonesia taking advantage of the low price to get rid of the structural subsidies they used to give. So they've immediately said, here's something we can take advantage, get rid of subsidies that everyone's been criticizing us for some time. It's good for China. So the other thing that I'd observe is that a bit like when you invest in a financial asset, in a way it doesn't really matter what you sell it for, it's what the price you bought it in for. So the new capacity that's going to be put on in terms of energy, and you see the Mexican industry being remodernized or modernized, the cost of doing that is going to be significantly less than it would have been 12 months ago, when the cost of all the energy supplies and the supply chain and so on, the technology would have been priced off $100 oil as opposed to $40 or $50 oil. So the buy-in to the technology and the resources and the infrastructure for that industry is going to be much more sustainable. And the financial engineering that was going around the US shale industry, which was a large issue of high-yield bonds, has now been given a bit of a shock that the resource is still there, it's still very valuable, but you can't leverage it in quite the same way that was done historically, because there's a risk to the price. And that's probably a good thing too. So I'm actually very positive about the oil.
Good. Another kind of macro topic we should talk about, obviously, is the pending Fed rate rise. Conflicting signals this week, I think it's fair to say, about when that might come. But as an emerging markets specialist, if you like, Douglas, there's been worries all the way along about the impact on emerging markets of this rate rise and subsequent ones. Where do you stand on that?
Well, I think it's one of the big overhangs. I mean, dollar-denominated debt outside the financial system, outside the US, is now $9 trillion, 50% higher than it was in 2009. And therefore the concern has to be that if there is rate rises in America that sucks money back into America, there are going to be some financial shocks around the rest of the world. Now, this has been talked about for so long that it can't come as a surprise, and I think an awful lot of people have adjusted to that. But it is one of these areas where it's very likely we'll find out there are bits that we don't know about. Having said that, as I said, an awful lot of people have prepared for it. And you know, when you look at the infrastructure spending that's taking place across Asia, India, and China in particular, I mean, that is all good investment spending in relation to building a sustainable economy, a more sustainable economy for the future. So there are offsets. The flip side too is that for savers and so on, rising rates would at least give them some benefit back that they've been transferring to the over-indebted young.
Sorry, are you concerned about the spillover effect from the Fed and emerging markets into Europe?
Well, that has been, I think the point made was very, very important because, you know, in Europe we are focusing only, you know, on the euro-dollar rate from our own point of view, which is certainly good, the way in which it goes. But in the past, expensive dollar, you know, meant a lot of trouble in emerging markets. And the issue of establish really how much foreign-denominated dollar debt is out there compared to the past, which is not yet clear to me, and especially if it's still, you know, in a relevant quantity, how that will play on those economies and the impact on the global economy. That is a big question mark. And I think as Europe we should focus more on that, because I don't think the debate has taken that at all into consideration. We are much more focused on oil, when we'll stop, and you know, when the Fed will take the decision, basically. And on oil, again, I think if I may, we talk about the oil market, but it's a very peculiar market. And we know that there are a lot of decisions that could be taken, but nothing to do with really, a lot to do with politics and strategy from the big oil producer. And my understanding is that yes, there's an excess supply, but it's not a huge excess supply. So political decision, especially in the Gulf area, can, you know, basically turn that around very fast. So I think it is, you know, very difficult to call the shot, in my opinion, on when and if an inflection point is going to happen.
So lots of uncertainties, that's for sure. I could maybe zero in on the topic now of financing Europe, if you like. I guess a lot of the points that we will discuss are not specific to Europe, but the structure of finance has changed incontrovertibly since the financial crisis. The role of banks, the role of non-banks. Douglas, as the head of one of the biggest banks in the world, what do you see as the future structure of finance, and what are the key changes that we've seen either in Europe or globally in terms of the let's say the balance in particular between bank finance and capital markets finance for companies?
I think one of the positives from the post-crisis reform agenda has been that there's been some, and might be enough, perspective on where are we trying to get to, what do we want the system to look like when we're finished. We've done an awful lot of work looking at what we don't want it to do and what we don't, kind of shape we don't want it to have, but we haven't sort of said what would be the picture that would be ideal if we get everything that we want. And I guess there's one sort of blindingly big difference between the United States, two blindingly big differences between the US and Europe, which are interrelated in a way. One is, in Europe, the financial system intermediates mortgages, and it's increasingly apparent to me, at least, that in a world where we're going to have leverage ratios and liquidity constraints in a way that we didn't have before, intermediating low loan-to-value mortgages is likely to be much more efficiently done through the capital markets than the banking system. And in a way, maybe that's a very good thing, because it frees the banking system to do the kind of credit allocation that capital markets find very difficult, which is lending to small and mid-sized enterprises that is much more of a hand-holding than large corporates. So in a way you can say that that's one of the big structural changes that the shape of regulation might well promote. The other, of course, is that capital markets in America are much deeper, and I think the Capital Markets Union that has now been sort of promoted in Europe and now begins to get a bit of flesh on it is really, really important. It will never replace bank lending, because you still need banks to do the ad hoc financing when you can't go to the bond markets or you need something quickly, and I think banks will continue to have a role. Indeed, I think their prominent role should be in relation to small and mid-sized enterprises, because they're pretty unsuitable for the capital markets. So to free capacity to do that, and an awful lot could be done in the meantime in Europe to think about common prospectus standards, common disclosure standards, templates for securitization. An awful lot could be done to create the single market in finance in terms of securitization that should exist but doesn't exist today. So I hope we take that opportunity at a time when QE is meaning that there's plenty of money available for projects, if those projects can be properly specified.
There's a couple of points there that I'd like to pick up on. So you mentioned the balance of finance in the US versus Europe. There's this commonly cited number of roughly three quarters of US corporate funding comes through capital markets and a quarter from banks, and it's historically been roughly the reverse in Europe. I think it's fair to say over the past year or so, the new flow of funding has been far more away from banks and towards the capital markets. The other point is, of course, you mentioned the Capital Markets Union in Europe. On both of those points, Nikhil, it'd be very interesting to hear your views as a non-bank, as an investor in corporate finance, both directly, because you've done a fair bit of lending to companies in a kind of traditional bank-like way, but also you're an investor in capital markets instruments. What does Capital Markets Union mean, do you think?
I'll talk about bank lending or insurance lending to companies first. And I can really speak a little bit about what we did in the last 2 years. We lent about 20 billion plus euros to different companies around Europe. Now, we didn't take away business from the banks per se. The banks were still there with these companies, but we started to offer some medium and long-term opportunities to companies to borrow. And I think essentially these were in bond format, but they were really loans. And so we've been doing it, and I assume we've been doing it, other people have been doing it too. So that 75-25 or the 80-20 that you mentioned at the beginning, that's going to just come down. It's not going to go 50-50 or whatever. I think it's already coming down. So while people are debating it in the last 2 years, it's actually been coming down. Now, you could say, well, are you lending to SMEs or normal companies? And it's been a mix. I mean, I wouldn't say we've lent a lot to SMEs, but SMEs have had a hard time in Europe outside of places like Germany. So that's there. So we've been active, and I must admit, though, that the actual opportunities have gotten fewer and fewer in the last, as the couple of years have progressed. Capital Markets Union, I don't quite know what to make of it, so I'm not going to pretend to give you an answer on that. I really don't know what to make of it. I'm sorry to be naive about this.
I think that there is some skepticism that it's a lot of hot air. As Douglas says, there are very concrete things around Europe that could help create a single market, harmonisation of legal standards and templates and so on. Vittorio, what would you say needs to be changed in European capital markets to make it work as a single zone?
After the crisis of the new regulatory environment, boundary has been shifting, and I think two big boundaries. One is between banks and capital markets, and the other one is between regulated and unregulated business. I think the first boundary, to me, is a very good boundary to move, for the reason we have just said. And as banks, I don't think, sometimes you put some sort of a conflict between the banks and the capital. I don't think there is a conflict. I think there is huge synergies. I think that in Europe, too much banking has meant banks cannot carry the whole economy, and so I think a wider choice for the corporate world means healthier, larger corporate world where we can all thrive. And I think in that direction, you both rightly said, what exactly is this capital union? I mean, I don't think anybody really knows, and in fact, the European Union themselves are sending out questions to write their green paper, because they have to really find out what are the real difficult topics to address. On the boundary between regulated and unregulated business, then I have my mixed feelings, because somehow the whole idea was to decrease the level of systemic risk in the system, and just basically, I don't think that risk-taking by banks is a bad thing. It's just have to be proper risk-taking. But somehow you have the feeling that there are some areas where risk-taking by banks has become so unprofitable that they are leaving the business. And the business will not disappear, will be taken over by unregulated entities. But now my feeling is that are getting closer and closer to customer, and the whole issue of mortgages, I think I agree, there are some part of a mortgage area how to digest through the system that probably are done better by capital market, but that has to be something that the customer acknowledges, because they're going to change in counterparty, and what does it mean, So I think that all kind of education on one side, and that proper evaluation of who's supposed to take the risk in this area, I think is still, I don't think, really well thought through.
Yeah, please.
One of the other things I think sometimes gets forgotten is capital markets can only intermediate. Banks create money. Only banks create money. And therefore the scale of the size of the economies in terms of credit formation, capital markets can allocate savings and so on. Banks can actually increase the volume of credit because they create money. And I think therefore that there's always going to be a role because there's going to be a need for credit creation. So.
You talked about the shift of mortgage finance, for example, into the capital markets, and securitization vehicles to do that have been, well, traditionally less developed in Europe than in the US. Post-crisis, they've been virtually non-existent. What is needed to get securitization in Europe going? There's a lot of talk that it can never get going as long as we're in these ultra-low QE-fueled environments that we're in, because liquidity is so plentiful. Why would banks seek to offload assets into securitization vehicles, which is a more expensive route to finance? But I guess we can plan ahead for a time when we are in a normalized environment. Would that be your view, Douglas?
Absolutely. I mean, it's been one of my frustrations over the last 4 years of going to meetings in Brussels and indeed here about everybody agreeing that securitization needs to be revived, everybody agreeing what needs to be done, and 4 years later still talking about the same topics. It does seem to, you're absolutely right, in a QE world there's no great juice in securitization, there's no great need to take assets off balance sheet because of lack of funding. But this is the opportunity to look at what does good securitization look like, what kind of assets do we want to securitize, what should be the common standards, and then reflect about what makes securitization markets work, and reflect perhaps on, we have a framework today where capital allocation to an asset securitized is higher than the capital allocation to the same asset lent directly, and you would have to say, logically you would think it ought to be lower because there's more liquidity. You'd also want to say that to get people to buy securitized paper, they have to be assured they can get liquidity when they want it, and we've created a system where market making and inventories are much lower. That was a desired outcome, so we've achieved that. But then if we want the securitization market to grow, then we need to think a little bit more about what market making and liquidity support we want to be available, and if not from the banks, then from whom? Because we can't have a securitization market, in my view, that grows, particularly if we're trying to securitize illiquid paper, illiquid assets, and then say, but you're holding it long term. That's not what securitization does. So there's a broader review to be done, which would be good to do when we're not kind of in a scenario where we need securitization, but we can prepare for the time when we will.
You mentioned there, or you alluded to the rules being maybe restrictive in some ways. How confident are you that regulators at a global and regional level may compromise in terms of changing those risk weightings, for example, on securitization?
You see, one of the things that, you know, when I sort of do my wish list, it would be when the media would stop using words like compromise, as opposed to saying, because it implies that somebody's lobbied for a retreat from what is right, rather than saying, when the facts have changed, maybe we can step forward and create something that's good. So I think, you know, we are post-crisis. We are at a time we're looking for growth. This isn't a question of retreating. It's a question of reviewing afresh and saying, what do we need to do that's positive, and selling a message not as a sort of a weakening of standards, but of an adjustment to a new economy. And I think, you know, I think actually it's for policymakers to give a message to regulators in terms of where they want the prioritisation to come. So much post-crisis was about stability and prevention of recurrence, and I can sense a real shift in politicians, and particularly in the Commission, that now that is largely done. Can we now think more positively about what we need to do to the financial system to promote growth? But that then needs to filter through to Basel and other places, Financial Stability Board, to make sure that the policymakers promoting growth are getting the support they need from those that still have constraint and stability as a primary preoccupation.
Okay. One of the other areas that bankers often talk about being a brake on growth and potentially being disruptive to future stability, Vittorio, is the effective restraint that's been put on banks' ability to market make. Inventory being held on bank balance sheets is just not economic in a post-crisis regulatory environment. How dangerous do you think that is, and do you see scope for, I won't use the word compromise, but a rethink from regulators?
I think there is certainly a room for rethink about it, and I think October 15 episode, I don't know how many are familiar, but when in a very benign market conditions, there were like a breakdown of the US Treasury market. We're not talking about the Italian, bond or, the Treasury markets. And I think that regulators look at that and they are thinking about what happened. And I think my own view is was evidence that what was used to happen, huge market making, that was a shock absorber during certain condition, was not really active. And I think that many big banks that have been really prime institution to do this market making shock absorber function, because of a new capital requirements and capital charges, are not in that business. And I think that is quite dangerous, because to me, let alone in difficult time, not in a benign time, not having that kind of shock absorber, institutions that are willing to basically counter the market and put on their book what people don't want to have in their book, or going short the other way around, is absolutely necessary. Otherwise, you will find that central banks would have to do all the job all the time, and I think it is not why we created even the system with central bank. So, and this is all to do with what is the right amount and proper risk-taking by banks. And of course, I think capital charges are very good, and they are there to discourage sort of speculative behavior, aggressive behavior, that in certain institutions shouldn't be there. But when they discourage, exactly, put on your book for a while something that the market right then cannot really digest, I think is not a good idea. So, and I think along this line, I think the rethinking to me is, let's look a little bit deeper, let's be a little bit finer with capital charges, is asking why certain asset end up on your books or not. And I know it's difficult, but I think for having a safer system, I think is necessary.
It's Nikhil's view on this would be very interesting as well.
I don't disagree. I think as an investor, I'd like to have the opportunity to buy and sell more easily than I have today. And all it does for people like us is, when we have the situation right now, we just have to be much more careful about what we buy, because we know we can't sell it. So, I think that creates a discipline, which is very good, because I think without the discipline, you're always buying things you think you can sell if you make a mistake, and you can't do that anymore. But that's not an ideal situation for the average investor, so having that would obviously help.
And that makes markets more volatile, right?
Yeah, this volatility thing is, people love to talk about the word volatility. I'm not sure. We are headed to zero rates for a very, very, very long period of time. So the disconnects that can happen in this are, they could be politically driven, they could be policy changes to the Fed, which are probably unlikely in the next 12 months, they could be other things. But we just have to accept the fact, at least on the fixed income side, you're not going to see a lot of volatility for a very long time in the European markets.
Yeah, no, very good point.
Yeah.
I'd like to switch topics onto the future of banks, if I could. Douglas, as I said earlier, you had one of the biggest banks in the world. What is the future of banks?
Very, very good. For all that's said about banks, no one's said very much about banking. It's in a world where there are so many investment opportunities over the next 2 or 3 decades that have to be done around urbanization and infrastructure and all that kind of stuff. The credit creation capacity of banks is I think, undoubted. But I think they'll change. I think they'll change a lot. Clearly, there's an issue that will play through for the next several years around scale and manageability, if that's a word. I think technology is going to make a big difference. On one level, it's going to enable better levels of service, more delivered to customers in a way they find more attractive, because I think the statistic is 80% of the people will have a smartphone by 2020 or something, which is kind of scary also in terms of how you manage the risk of everybody doing something remotely at the same time. And I think they're going to have to prove their business models, and I think that's probably one of the good things, again, out of the last several years, is that banks are having to say what they are, as opposed to the fact that they take a variety of opportunities as they arise all over the world. They are going to have to hunker down to be domestic intermediation kind of businesses, or trade and investment finance businesses like we are. They're going to have to define their purpose, and they're going to have to get societal acceptance and agreement and support for that purpose. I think technology, though, is going to be huge. One of the challenges I think that's going to play hugely over the next few years, particularly in Europe, is there's a tremendous desire for competition from non-traditional sources, which is a good thing in many ways. And aggregators who can put all sorts of financial affairs together and give a really neat app for people to manage their money. But at the end of the day, we're going to have to get very comfortable about where responsibility lies when things don't quite work. And most importantly, we're going to have to think very thoughtfully about how do we make sure people understand where their data is held, who has responsibility for that data, and whether it's shared. And I think Europe will have a very, very different view on that than the United States and other parts of the world, because it's clear that the tech companies, or some of them, don't really want to do banking. They want to have access to everybody's wealth and transactional spending patterns, because that's a very, very rich data stream for which they will give away transactional banking, whatever, for free. So I think there's really a very big public policy debate to have around privacy and data ownership, which will be part of how banks shape up. But the most fundamental thing, and I'll stop, the most fundamental thing is that there is a crushing need for banks to define and get accepted what their purpose is, because I think there is still a very big gap between what banks think they do and what the public thinks banks do, and we need to bridge that.
You mentioned there the competitive challenge from tech companies, for example. You've obviously, as an industry, had a heck of a lot of fallout from the financial crisis, both in terms of direct losses, the regulatory response, supervisors, conduct regulators trawling back over the past 20 years of conduct. It's been altogether a pretty poisonous cocktail for returns in the sector. And I just wonder, from Nikhil's point of view as an investor, to what extent are banks today investable, given the very subdued returns that are available?
I think it depends on which part of the capital structure you're looking at, but if you said bank equity in Europe, particularly the next 2 or 3 years, I'd be cautious because I can't see banks really making high ROE. And if you go back to Japan, when their crisis started back whenever it was, in the 80s, 90s, you had a period where the stock market went up and then it didn't go anywhere for many, many years. And if you look at, well, Japanese banks did, they were big and profitable beforehand, they had a hard time. So if I try and replicate that here, and I'm not saying we're in the same situation, we're probably slightly worse off, you could argue, in Europe, I'd say that I would not want to be an owner of bank stocks in the next couple of years. And I don't refer to particular banks that may have a good strategy, which I'm just talking about the sector in general, right? Because I don't know how they're going to make their cost of capital, even if it keeps coming down. And that's not to talk about the technology, because I think Douglas mentioned the technology, and the stuff that's happening today on the technology front is just phenomenal. And the banks spend a lot of money on what they call technology, but they're really not at the forefront of it. Some are. For example, like there's one large European bank now that's experimenting with this. When you go in and ask for a loan, rather than ask you to fill out forms, to give you a series of pictures. And based on the choice of pictures, they'll tell you whether you get a loan or not. Now you're like, wow. I mean, but that's happening, and they're testing. And this is a serious bank, testing this out in a couple of their markets. Not in Europe yet, because the regulator will go crazy. But I mean, but these are things that are happening, and that's from a large bank, and that's not from a tech company that's saying, okay, we'll disintermediate you, we'll make things more efficient. But we have no idea what's going to happen in the next 3 to 5 years with technology. The only thing that's going to stop the pace of technology adoption is going to be regulation.
Can I get a quick response from Douglas on that point you made about banks generally, obviously with the honourable exception of HSBC and JP Morgan, and not going to be able to make their cost of capital?
Yeah, I mean, I think that's a really, really good challenge, because in a way, if you stand back, one of the questions policymakers should make is, if we want to create an environment where the public can be reassured that the state doesn't have to step in and rescue the system again, then the answer is that if you get, obviously it's systemic, it's a very different game, but if you get idiosyncratic failure, you want the bank to be recapitalised by private capital, which means that you should aspire to a system that covers its capital. There are very few systems that are as heavily regulated where the system doesn't kind of organise itself to make its cost of capital. And so the challenge kind of is, we've been 7 years post-crisis, we've doubled, tripled, quadrupled, quintupled, depending on where people started their capital. We've got massive more liquidity, much better supervision, no proprietary trading, structured products are regulated out of existence, and on and on and on, central counterparties. And cost of capital hasn't moved. So, you could say to policymakers in a kind of a way, how come we've done all this, and yet the markets score back to you as nothing's changed? So, in a way, if you were scoring the system, it would be, maybe there are costs to adjust as well, that's probably part of it, but in an ideal world, you would create a system where the system said, I'm getting my return, therefore I'm prepared to recapitalise idiosyncratically when something goes wrong, chuck the management out, put in better managers, but the system is... And if you look at Australia, Canada, Hong Kong, Singapore, they have those systems. They make good returns, and therefore, in the event of something going wrong, the system would recapitalise. We should think about whether we need to aim towards them.
I think that there's been a structural change in banking. Rules have changed. Maybe for a long time, but market condition, monetary conditions have changed, which have been challenging business models. Different banks have different business models, but for all now the environment's much more complex, much more diversified. So certain business models have to be revised deeply, and I think that is going to be more than a competition challenge, is really a challenge to adapt to a new environment that has had a big structural change. And so, for example, to be a real global bank, to be present in all relevant segments of the market is going to be a huge challenge. It's very complex. You need talented management, huge investment in technology, and a right vision and strategy, so it's not going to be obvious at all. But banks, under the label of banks, are very different animals, and I think people will look at the business model and will take decision of, well, what kind of bank I want to be. And I think there are going to be a lot of changes in strategy and shifting from certain kind of business model, a certain bank to others. And I think we are seeing that, and I think will continue for quite some time.
That's Douglas's point of the market not having kind of changed its view of cost of capital. Do you think there's just a lag effect there, that it will, once those business models are clarified?
I think it is right, but I think probably my interpretation is market has understood that, the paradigm has changed. So they want to see how you adapt and how successful you are before they change the price of capital to you. And I think then there will be a big difference as they see deployment of plan that work. I hope and I think that will change.
We're running to a quite tight schedule here, so I'm conscious that there may well be people in the audience who have burning questions they'd like to ask this eminent panel. And do raise your hands if you do have any questions. Very good. Just to the front here, if you could identify yourself and then ask a question.
Hi, my name is Silvia and I work in Switzerland in banking. So I would have a question relating to Switzerland for Mr. Vittorio, for example. Switzerland always played a big role in terms of banking, and now we are living a big change in terms of data regulation. And so I'd like to know how the rest of the world is living this experience, and how do you think this will affect on a short-term and medium-long term Switzerland itself, but for the rest of the world itself too, from a banking point of view? Thank you.
From Switzerland, well, I think part of the new wiring of the system is not just risk-taking, but transparency, and that is a big topic. And for a million reasons, we go from tax evasion to really criminal activity, international activity like terrorism. So that is another game changer, which means that, as I was saying before, certain business models, they are not going to work, or at least to make them work, you have really to change deeply. So Douglas already mentioned data treatment, which is a huge thing, which is both a technological issue, but also some sort of deep political issue, because there's a line between transparency on one end and confidentiality on the other, where confidentiality is not always a bad thing, it's just, it's like something that has to treat it. So my view is, and what we're seeing, for example, in Switzerland, what I've been seeing in Switzerland is part of this adjusting the business model to the new reality. And I don't think the picture is completely clear yet, and I think in the next few months we'll see how successful is this transition. Now, my view is this competitive environment is going to change amongst banks, because in certain category the kind of participant is going to thin out, and so from that point of view one has to take that into consideration. But I think that's what I could say on this point.
Very good. Any other questions? Just Dan. Oh, sorry, yes.
Yes, I'm Marina from Milan, KPMG Risk Consulting. Focusing on the emerging movement of fossil fuel divestment, I would like to ask, I was wondering if you see a contradiction between cheap oil and a more sustainable and healthier economy in the future, going back to the introduction of the debate. Thank you.
Okay. Maybe Nikhil, you have views on oil?
Tough ones. No, I really don't particularly see that. I mean, cheap oil is just going to be there for a while. That's going to affect how much people are going to commit to sustainability, for sure, because governments can adjust much quicker when they see an opportunity, and Douglas mentioned that earlier, when they cut subsidies. So cheap oil is not good for sustainability. Okay, that's the bottom line.
Anybody else?
Then you may think the opposite, but talking to people in the energy business, they say that a big chunk of demand for energy, including oil, comes from really the adaptation to the society to higher standard about sustainability. And so the sheer demand for energy has decreased. So I think that there is that part that you have to take. There is a big trend all over that there is much more awareness about energy consumption. And of course, the generation of energy also adapted to that, and so, of course, you may think that cheap oil means that people use it more, but in a trend that is going absolutely in the right direction.
Okay. Davide.
Davide Serra from Algebris Investments. Simple question. If I'm a client of HSBC or JP Morgan, they can only invest my own money into liquid assets in Europe for MiFID regulation. If I'm an insurance client of Nikhil, he can only invest 4% of my own money in a life policy in equity. So the bottom line is that in Europe, less than 3% of European savings can actually be invested in equity via intermediaries. As you know, SMEs account for 70% of the jobs, but basically there is no capital for them because the regulation between MiFID, Solvency and Basel III is prohibiting this. Do you see this as a blockage for growth? Because there's plenty of money printed by banks and the central bank that is not having an effect on jobs. Everybody talks about jobs, but there is no equity for this job. Do you think this is an issue? How it should be addressed? Does it have an impact?
Sure. I mean, I absolutely agree with you. I think you make a comparison between how much money goes into equity today as opposed to 20 or 30 years ago, and it's significantly less, and that's because we've tried to, through regulation, make assets much more realisable at a fixed amount rather than take risk. As you know, in the UK, the banks got together 5 years ago and set up something called the Business Growth Fund to put equity into small businesses, which was partly a good thing for the economy and partly obviously to create an equity underpin to more lending. So it was a good thing, and 5 banks all committed £500 million, which is actually a very huge amount of money when it's only going in at 10 million, up to 10 million at a time. So I think there's a need for Europe, indeed more generally, there's a need to put equity to work into small businesses and to find pooled vehicles that will do that. And probably a reflection in a world of ridiculously low interest rates by historic standards for a broader reflection as to whether we should take some of the constraints of the insurance and pensions industry and putting money into equity.
I agree with that, but really there's a broader macro thing. You've got to cut taxes, you've got to reduce the cost of doing business in Europe. There's a huge cost of doing business in Europe, and I come from Singapore. I tell you, the cost of doing business in Italy or France or anywhere else is formidable. What the Spanish did last year, they announced corporate tax and income tax cuts, and that's come into effect in January. They've cut taxes significantly. Corporate tax are going from 30 to 25, income tax are down about 5% as well. That's what you need. You need to cut taxes, you need to make the cost of doing business cheaper. Okay, and I appreciate there's a need for equity and all that, but that's the big thing, and that nobody in Europe wants to talk about yet, seriously.
That's a very good point. We've got time for probably one more question, I think, or possibly two. Yes, the lady.
Fabio Schirpo from Geneva. The subject of the panel is financing growth, and so we have correctly been discussing about some of the tools that are being used by finance to fuel growth. And when it comes to measuring the growth, we are very much accustomed to some quantitative measurement of growth. But what about the quality dimension of growth? This is something that I have the impression is a bit left aside in our average discussions. And I'd like to mention that because during the discussion has been mentioned crisis that has hit Europe and the world over the last few years. As a matter of fact, I think that what used to be growth in the past, the way we were building our growth, is one of the reasons why we have come to such crisis. And therefore, my question about difference between quality and quantity, because what used to be growth in the past, now we measure it as distraction. So, if you like, to put it bluntly, the question is, how much distraction, allow me the word, should we accept for the sake of growth?
It's a very good question. It builds on the last question partly, I think, in terms of the role that equity should play going forward, because, as you say, a lot of the growth of the past was debt fueled, and obviously we've seen debt actually increase globally since the crisis rather than decrease. So, Douglas, do you want to take that first?
Yeah, I mean, so one of the other major steps forward, I think, in the last few years has been the introduction of macroprudential regulation policies, controls in a number of countries to try and avoid misallocation of resources where bubbles form, where the whole market sort of rushes to a particular asset classes and creates that misallocation that was part of the crisis back in 2007, 2008. And I think that the missing piece of macroprudential regulation in terms of looking at the shape of credit allocation and the scale of credit allocation, in our view, sustainability comes from a sort of a Goldilocks scenario. Credit formation has to be not too little and not too much but not too little either, and then making sure that there's a balance. And I think we're in the early days of seeing how effective that can be, but I think it's really important, and hopefully will have some kind of shaping effect that will prevent or at least moderate the next crisis.
No, I agree. I mean, I think it's still a question of measurement to me. We were measuring growth. Well, we were measuring instead, part of it was a bubble, and so we weren't measuring it properly. And now I think that regulator understood that, and all the attention now that was not there. Now is obvious, but up to 2008, the idea that asset prices were something that you had to watch for and monitor and be careful was not really embedded in the system. And now I think this is now part of a more holistic approach that all central bank and regulator take. So that doesn't mean that bad things will not happen in the future, because history is always like, if you think that you're done, you're not, certainly. But we learn from the mistakes, and now are in place, let's say, measure to avoid mismeasuring growth, and instead of looking at a really temporary bubble that will burst.
Nikhil, a final word?
No.
No? Okay, we've got, I'm afraid we've reached the end of our time slot, and so apologies to anybody who still had a question to ask. I'm not sure we've solved the enigma of finance and growth either in Europe or anywhere else in the world, but at least we've had a very interesting debate. My thanks to Douglas, Vittorio and Nikhil for their contributions, and thanks very much for your attention.